Welcome to the Byte-Size Brief. Today we are putting Robinhood, H-O-O-D, that's H-O-O-D, completely under the microscope. Let's get into it.
I'm really looking forward to this one.
Same here. Because, think about it. What if I told you the exact same app that teenagers use to, aggressively trade meme stocks back in 2021 is now acting as the primary retirement vault for a massive wave of 19-year-olds?
It does sound completely counterintuitive when you put it like that.
Right. It sounds entirely counterintuitive.
Yeah.
But what we are looking at today is a monumental shift in market structure. Like, over the next 10 to 20 years, we are staring down the barrel of the great wealth transfer.
Oh, absolutely. The numbers are staggering.
Yeah. Somewhere between $70 to $90 trillion is going to migrate from the baby boomers down to younger generations. And, well, the battle for where that capital actually lands is the most important story in finance right now.
It truly is. It's the single most certain structural dividend for the financial industry in our lifetime. And this deep dive is really about examining the actual mechanics of that shift. We need to objectively assess whether Robinhood, HOD, is successfully executing its transition from a zero-commission trading tool.
Which is how most people still see it, honestly.
Exactly, which is how most of the market still perceives it. But they want to transition from that into the absolute default destination for this wealth transfer. They're attempting to build a comprehensive financial operating system, a fully integrated ecosystem, rather than just a clean interface for executing an options trade.
Exactly. So to you listening right now, I have to ask, do you still view Robinhood, HOD, as just an app for meme stocks, or are you ready to see it as a long-term wealth manager?
That's the billion-dollar question.
Right, because to capture even a fraction of that $70 trillion, they have to prove they can structurally retain user wealth. They need to keep the capital inside the walls of the app, not just facilitate rapid-fire trades that eventually, drain a user's account. And the internal data we're analyzing today paints a fascinating picture of how they are actively rewiring user behavior to make that happen.
It's a fundamental pivot in behavioral economics.
Yeah.
The mainstream narrative often accuses Generation Z of, inherent financial irresponsibility. People assume they treat the equities market like a mobile game.
Oh, totally. The casino narrative.
Right, but the actual user data completely contradicts that. CEO Vlad Tenev recently pointed out a staggering metric. Gen Z users on the platform are aggressively opening retirement accounts at the age of 19.
Wait, really? 19?
19. That is completely unprecedented in modern financial history. Previous cohorts typically didn't even conceptualize retirement planning until their mid to late 20s.
Yeah, usually when they got their first corporate job with a matching 401k.
Exactly.
19. At 19, my biggest financial strategy was figuring out which dining hall had free pizza.
Well, you weren't alone there.
But if you think about the underlying mechanics of why this is happening, it makes complete sense. The friction of traditional finance has been entirely eliminated.
That's a huge part of it.
Right. You don't have to schedule an appointment, put on a suit, walk into a brick-and-mortar bank, and fill out a stack of intimidating paperwork with a wealth advisor who uses language designed to confuse you. You just, tap your screen.
It's frictionless.
Plus, we have to factor in the macroeconomic reality here. With the gig economy dominating job growth, a massive segment of younger workers simply do not have a traditional corporate 401k waiting for them. They're being forced to take asset allocation into their own hands.
Precisely. The access has been aggressively democratized. But what's more impressive is how Robinhood, HOD, has applied their famous user interface to incentivize long-term holding.
Oh, so?
Well, currently, 40% of the assets on the platform are sitting in passive products. We're talking about exchange-traded funds, cash sweeps, and structured retirement accounts.
Oh, wow, 40%. That's way higher than I would have guessed.
Yeah. They have effectively taken the immediate feedback loops, the slick animations, the progress bars, the intuitive design that used to only reward rapid trading, and they've mapped them onto passive wealth building.
That's clever.
It is. This reflects a dual behavior structure. Long-term investment is actively becoming the primary engine for asset under management growth. Meanwhile, strategic active trading serves as a secondary high-margin engagement tool.
But let's not pretend the active trading side has disappeared. I was deep in the retail options communities recently, and the sentiment there reveals a very distinct divide.
I'm sure it does.
Yeah, the retail crowd still absolutely praises Robinhood, HOD, for having the cleanest, fastest UI in the business. Like if you are trying to execute a rapid order entry on a 0 DTE option in a volatile market, their mobile experience is practically unmatched for speed.
Right. The sheer execution speed on mobile is their bread and butter.
Exactly. However, the advanced users, the ones actually driving significant volume, are highly vocal about the platform's limitations. They're constantly pointing out the lack of complex options Greeks, the absence of detailed volatility surface breakdowns, and, the inability to set up automated conditional exits like trailing stops.
Which is a very fair criticism.
Right. You see those features natively on platforms like Moomoo or Thinkorswim.
Which is exactly why those competitors serve as vital benchmarks for professional-grade trading infrastructure.
Hmm.
Robinhood, HOOD, is acutely aware of this capability gap.
Hence the desktop push.
Exactly. That's why they have been aggressively rolling out the Robinhood Legend desktop platform. They have a strategic imperative to bridge that divide because they absolutely must retain those highly active, sophisticated traders.
Because they bring in the fees.
Yep. That cohort provides a massive chunk of their transaction revenue, especially during macroeconomic events that spike market volatility.
Hold on, so it's kind of like they lured us in with the flashy casino games and fast UI, but now they want us to stay for the savings account and the buffet. How does that actually affect Robinhood HOD's stock price for regular investors like me?
That's a great analogy. Ecosystem Trap is the perfect analytical framework for this. And to answer your question directly, this drive for ecosystem cohesion is the central thesis driving the stock's valuation.
Really? The cohesion itself?
Yes. Historically, Robinhood, HOD's Achilles heel, was its heavy reliance on transaction-based revenue, specifically payment for order flow on options and crypto. That mechanism makes earnings incredibly volatile.
Right, because if the market gets boring, people stop trading.
Exactly. If the broader market is flat and retail enthusiasm wanes, trading volume plummets and revenue falls off a cliff. But by pushing the Robinhood Gold subscriptions, the new Gold credit card, and offering highly aggressive 1% to 3% matches on retirement deposits, they are engineering sticky recurring revenue.
Because the mechanics of that 3% retirement match actually force retention, right? Like if I take that match, I have to keep my capital on the platform for 5 years where they claw the match back.
Precisely. That is a massive moat.
Yeah, once my retirement account is locked in, my daily credit card is tied to the app, and my uninvested cash is sweeping at 5%, the switching costs become impossibly high. I'm not leaving to go back to a legacy broker.
Exactly. The switching cost goes from being purely preferential to highly punitive. You become deeply embedded in the ecosystem.
Which Wall Street loves.
They adore it. This systemic shift decreases their reliance on unpredictable, volatility-driven trading fees. It replaces it with a predictable compounding revenue stream based on assets under management and subscription fees.
Makes sense.
And when institutional Wall Street analysts see predictable compounding revenue, they are willing to assign a significantly higher valuation multiple to the equity. It essentially proves that the platform's business model can survive and grow even in a sustained bear market.
Okay, so compared to last quarter, what actually moved the needle here? Because, building an ecosystem is a great theory, but if we are looking at the realities of the market right now, is this strategy translating into hard financial results?
The sequential data from the February 2026 operational update is actually staggering.
Lay it on me.
So they hit 27.4 million funded customers.
Wow.
And in the month of February alone, they pulled in $6 billion in net deposits.
Wait, $6 billion in 1 month?
1 month. To contextualize how massive that is, they brought in $68 billion in all of 2025, generating roughly 10% of your entire previous year's net deposits in a single short month. Demonstrates immense momentum.
That is just ridiculous volume.
It is. Furthermore, their crypto notional trading volumes absolutely exploded to $25 billion for the month.
Jeez.
Yeah, that represents a 74% increase year over year. Consequently, the expectations for Q1 are highly robust. Consensus estimates are projecting revenue to hit $1.15 billion, which is a substantial leap from the $927 million reported in the same quarter last year.
So basically, it's kind of like the business is running on absolute rocket fuel right now.
It looks that way in the top line, yes.
But wait, let's critically examine that $6 billion in net deposits for a second. How much of that is truly sticky, organic wealth generation, and how much of it is just like mercenary capital?
That's the primary risk factor.
Right, because we know retail investors will chase yield. If I'm transferring an old 401k purely to extract that 3% match bonus, Is Robinhood, HOD, actually retaining me as an active participant in their ecosystem? Or am I just parking my money and deleting the app?
Exactly.
Because if it's the latter, they're essentially just buying assets under management at a highly expensive margin cost.
That is the exact risk factor keeping institutional investors up at night. And it perfectly segues into the market's current pricing behavior.
How so?
Because despite these phenomenal top-line and quarter-over-quarter growth metrics, the stock is actually experiencing a highly notable pre-earnings pullback. We are looking at it trading around $81.75 right now.
Which is a pretty violent drop from where it was trading just a few months ago.
It is. That represents a 27% decline year-to-date from its 2026 highs, and the core mechanism driving this pullback comes down entirely to valuation multiples. Robinhood, HOD, trades at a premium price-to-earnings multiple of 42.2x.
22.2x, man. And if we compare that to the legacy incumbents, Charles Schwab isn't trading anywhere near 42 times earnings. They typically hover around, the mid-teens or low 20s?
Exactly. Usually right around there.
So the market is pricing Robinhood, HOD, not as a traditional financial brokerage, but as a hyper-growth tech platform. They are demanding flawless execution.
Precisely. It is a valuation that requires absolute perfection, which is why Wall Street analysts are so fiercely divided right now.
What are they saying?
Well, JP Morgan just recently downgraded their price target to $92, maintaining a neutral rating. Their rationale is strictly tied to that premium multiple. They argue the stock has run up far too fast relative to the actual stabilized earnings power of the company.
Interesting. And the other side?
On the other side of the aisle, Mizuho maintains an outperform rating with a much higher $115 target. They are looking at the underlying momentum in user acquisition, the rapid adoption of the Gold subscription, and the massive runway for international expansion.
So it's a complete split.
It really is. But the ultimate takeaway from this dichotomy is clear. Until the legacy volatility of payment for order flow is permanently overshadowed by recurring ecosystem revenue, institutional capital will remain highly cautious.
Makes sense.
A single miss on an earnings report or a sudden drop in crypto volume can cause a severe multiple compression when you're sitting at 42x earnings.
It's an incredible high-wire act. They are essentially forced to prove the hypergrowth narrative every single quarter. And to justify that massive 42.2x PE ratio, they can't just be a slightly sleeker version of Schwab. They have to fundamentally change market structure.
Exactly right.
Which is why they're aggressively pushing into some seriously experimental infrastructure. They don't just want to change how we trade. They want to completely redefine what and when we trade.
This is exactly where their strategic roadmap pivots away from traditional finance and ventures into the bleeding edge of market mechanics.
I am endlessly fascinated by the mechanics of this phase. We're talking about the push for true 247 markets. They are actively trying to destroy the concept of Monday to Friday, 9 to 5 exchange hours, which frankly feel archaic in a globally connected world.
Very archaic.
Yeah. And they recently secured in-principle approval to operate in Singapore, which is a massive foothold in Asia. But the really disruptive technology here is asset tokenization.
The tokenization push is huge.
It is. They are already live, offering tokenized stocks to retail investors in Europe. And they are actively building out prototypes to give everyday retail investors access to private equity. We're talking companies like SpaceX and OpenAI.
They even backed OpenAI directly with a $75 million investment.
Which is wild. And on top of all that, we are seeing an explosion in prediction markets natively integrated into the platform. Vlad Tenev has been very vocal about this. He doesn't view prediction markets as mere gambling. He refers to them as truth pricing mechanisms.
The overarching ambition here is to permanently bridge centralized finance with decentralized finance. Let's look at the actual mechanics of how they're executing this.
Okay, let's hear it.
By deploying their own Layer 2 network, the Robinhood chain, they're essentially building a parallel clearinghouse. Instead of relying on traditional clearing firms that require T+1 or T+2 days to settle a trade, a tokenized asset on a Layer 2 blockchain settles instantly.
Which changes everything.
It drastically reduces counterparty risk and frees up massive amounts of capital. It allows them to offer continuous global liquidity for assets that historically have been highly illiquid and locked exclusively behind the closed doors of Silicon Valley venture capital firms.
Right, because if you tokenize a share of SpaceX, you can chop it up into microfractions and trade it on a Sunday night. It completely democratizes private equity.
Theoretically, yes. However, the immediate legal and regulatory risks associated with this infrastructure are immense.
There's always cats.
Robinhood, HOD, is currently facing active lawsuits over those very prediction markets we just discussed. Regulators are deeply concerned about the gamification of binary event outcomes.
Which, to be fair, is a valid concern.
It is. Furthermore, Robinhood, HOD, recently suffered a targeted phishing attack that exposed customer emails.
Oh, that's not good.
While no funds were compromised, it highlights the severe systemic cybersecurity risks of operating as a centralized hub holding billions in digital and fiat assets.
Security has to be flawless. If you're aiming to be the personal vault for the great wealth transfer, a single breach of trust is catastrophic. But what about the regulatory side of the tokenization push? They live in Europe, but the US market seems completely frozen.
It is entirely gridlocked. Robinhood, HOOD, is currently blocked from bringing those tokenized stocks to the United States. The Securities and Exchange Commission maintains incredibly strict, complex definitions regarding what constitutes an unregistered security.
The SEC strikes again?
Well, the SEC is fundamentally hesitant because the current framework wasn't designed for instant fractionalized blockchain settlement. There are intense ongoing legislative battles in Washington right now over the Clarity Act, which is an attempt to legally define the market structure for digital assets.
It sounds like a mess.
It is. Until Congress and the SEC provide a clear, undisputed regulatory framework, offering a tokenized share of OpenAI to a retail investor in the U.S. is a non-starter. The compliance costs and the threat of enforcement actions are simply too high to risk without a legislative green light.
Right, but what does all that actually mean for Robinhood HOD investors? Because regulatory gridlock in Washington could drag on for a decade. How does this experimental tech translate to the core business model we're evaluating today?
It means that the ultimate endgame for Robinhood, HOOD, isn't merely to exist as a digital brokerage that occasionally facilitates crypto trade.
Okay, so what is it?
The long-term vision, the actual structural pivot that justifies holding the stock at these premium valuations, despite the regulatory hurdles, is their ambition to become an intelligent asset management entry point.
What does that mean in practice?
Robinhood, HOOD, is actively developing AI agents designed to autonomously manage a user's entire financial life cycle.
So moving beyond just like a chatbot that answers customer service queries into actual algorithmic execution.
Exactly. Imagine a deeply integrated AI agent that continuously monitors your cash flow. It dynamically sweeps excess cash from your checking account into high-yield savings.
That sounds incredibly useful.
It goes further. It calculates your tax liability, automatically allocates the optimal percentage to your retirement ETF portfolio, and perhaps utilizes a strictly defined small fraction of your capital to execute algorithmic strategic trades based precisely on your personal risk tolerance. If Robinhood, HOD, can successfully engineer and deploy this system-level personal family office for the everyday retail investor, they completely rewrite their valuation narrative. They officially transition from a transaction-dependent brokerage into an indispensable, deeply entrenched wealth management ecosystem.
It's staggering to conceptualize. Like having an AI agent essentially acting as your fiduciary financial advisor, your tax accountant, and your algorithmic trader, all operating silently and continuously in the background of your smartphone.
It's the ultimate ecosystem trap we talked about earlier.
Exactly. And that really brings us to the core thesis as we look at the data today. Robinhood, HOD, has absolutely proven they possess the engineering talent and the scale to survive. They navigated the chaos of the meme stock era, they achieved JAP profitability, and they successfully earned their spot in the S&P 500.
They have achieved scale, yes. But 2026 is undeniably the pivotal year. This is the exact moment they must definitively transition from momentum-driven transaction growth, which is fundamentally reliant on volatile crypto spikes, and retail options trading to disciplined, recurring revenue compounding.
The big leap.
Right. The February net deposits are incredibly impressive, and the user acquisition funnel is clearly still working. But Wall Street needs irrefutable proof that this ecosystem cohesion can actually lock in the margins long term.
And if they can't?
Well, that $23 delta between the JP Morgan price target and the Mizuho price target exists entirely, because analysts are fiercely debating whether this transition to a holistic wealth manager is actually working, or if it's just a mirage fueled by temporary deposit matches.
It truly is a fascinating inflection point. They are sitting right at the chaotic intersection of traditional equity finance, decentralized crypto infrastructure, autonomous AI, and the largest generational transfer of wealth in recorded human history.
It's a perfect storm.
It really is. Which leaves us with a final, slightly philosophical thought to ponder. As Robinhood, HOOD, integrates AI deeper and deeper into the core mechanics of its platform, what happens when autonomous AI agents start executing the trades, rebalancing the portfolios, and managing the $70 trillion wealth transfer entirely on their own? Will the active human retail trading, the very chaotic, gamified energy that put Robinhood, HOOD, on the map in the first place, eventually become completely obsolete?
That is the ultimate profound paradox of their entire business model. They are utilizing the capital generated by human day traders to fund the research and development of the exact AI systems that might eventually replace them.
All right, listeners, what's your take on the future of Robinhood? Are you bullish, bearish, or sitting on the fence? Let us know in the comments. See you next time on the Bite Size Brief.